The following is a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice of KRLD or CBS Radio.
Welcome to the Common Sense Investing, or CSI show, with Victor McClure and Guy Allard from the Dillon Gage Wealth Management Companies. For the next hour, Victor and Guy will answer your financial questions with their own brand of plain-spoken language and hard-hitting style. If you've got financial questions, they've got answers.
Welcome to the Common Sense Investing Show. I'm Victor McClure. I'm your host and the president of the Dillon Gage Wealth Management Companies. My co-host, Guy Allard. How you doing, Guy?
Pretty good. What's going on? Just wanted to take a minute to thank everyone. We got some good responses from the show last week and some great emails. Keep them coming.
That's right. You just got through moving last week, didn't you? Was that great?
Well, the word through is relative. If you consider everything in the garage through moving, then we're through.
Every time I've ever moved, I said, this will be the last time I will die in this house, in this chair.
This will be our retirement home. We're done. I'm too old to move anymore.
Oh, and it happened to be 100 degrees the whole weekend, right?
Well, they used 3 of those 30-some-foot box trucks, and the last one drove to the new house. They arrived in the driveway at midnight.
Oh, boy.
So they were there until 2 or 2:30 unloading. Of course, at that point, everything was going into the garage so that we can sort it out and the staging area.
I know. I moved from the lake house on Cedar Creek Lake to Prosper, and I was shocked at how much actual crap you can accumulate over a lifetime.
Makes you feel like a hoarder.
Oh, my gosh. The garages are full of attics. I don't even know what's up there. But I know I have to keep it.
That's right.
I'm pretty sure I can't throw it away. That's the one thing. Oh, no. I had some old stereo equipment and computer equipment. This old crap won't work anymore.
What do you do with all the old monitors, right? I mean, they still work, but...
Well, I had a monitor go out, but the plug doesn't work. It's a different plug now, you know. I'm like, just throw all that crap away.
I got probably 3 or 4 extra of the flat screen 19-inch monitors, but I just don't need them.
And a lot of the technology advances, you can't use that stuff later like you think you can.
No, they don't have the 9-pin plugs now. It's USB or whatever.
Oh, yeah. Well, remember, we developed this show to answer your financial questions. We have a I don't know if it's unique. It's the only one I know of, especially on the radio. Our philosophy is to make sure if you have expenses in retirement, if you're going to retire, secure your expenses. I always tell people, I said, if you've got, let's say you've saved enough for retirement, you're going to retire, say, in a couple of years. Why are you still in the race? You've already won, as long as you make positive steps to prevent you from ever going broke. And so my biggest thing is pay your expenses with a guaranteed income stream. And then the stock market is fantastic for inflation protection, liquidity, all the different things you might need. But if that market's getting volatile like it is now, you just don't have any problems because you've got more money coming in your bank account every month than you got going out in expenses for the rest of your life.
Can you imagine being in retirement, being in your last house, right? We all got our last house, and having to come out of retirement and go back to work because the money was in the wrong place or you lost 40% of your value?
We talked about this last week, how a retired couple that I know, their pensions finally got their dream house, beautiful pool, outdoor kitchen, all that stuff, and they got to sell it 3 months later because their pensions were reduced. And it confirms there is only one thing that you can count on in retirement, and that's you. You surely can't count on the government, a pension, or Social Security, anything else. You can count on yourself. So you have to make positive steps to protect yourself from any kind of thing that might come up in the future. And believe me, if it can come up, it'll come up. I told my wife, about moving, it's the last thing I'll say. I said, I'm in the last house. She's already said, well, once the kids are out of school, I don't want this big old house. I'm like, I want to move back to the country. I'm like, oh, no. Stay here. Right here forever.
How many? You had, a 2-hour drive each way for 8 years?
Yeah.
When you lived in the country?
9 years, yeah. It was greatness. Now I live in Prosper, and it takes 2 hours to get to Addison. So there you go.
Yeah, that's going to get better.
No. It's only about 45 minutes, as long as there's not a wreck.
I know.
All right. There's one thing. I was driving back from Cedar Creek this last weekend, and I had a little time on my hands. I don't normally do this, but I listened to other shows, because normally my show is the only one that's actually listenable, but we listen to the other shows. One of them okay. I don't like the style of it, but decent advice. The other one was the worst thing I'd ever heard. This masquerading as a financial advice. I've never heard anything so bad. I'm sitting there going, somebody should put these people in jail. What it was is some real estate show, and they're talking about that some people were calling in, and so they're taking these calls. The first woman called in, and she said, I've got a $1 million, $800,000 IRA. And the first thing came out of the speaker's mouth is, get rid of that IRA right now.
It's not your money.
That's right. It's not your money. It's not you don't control it. So get rid of it. Pay the taxes. She goes, but I have to pay 28% taxes. And he goes, well worth it. We're getting 10, 15% a year. Heck, a lot of our rental properties, we're doubling your money in 2 years. I go, think about that, folks. You got an $800,000, $1 million IRA. If you cash it out, it's not 28% taxes. It's 39.5%. And you got an extra 1% Medicare when you make over $300,000 or $400,000.
So that's 600 you're netting out of $1 million, roughly.
That's right. It's terrible. You basically have just told a person to bet everything they've got on real estate, lose half of their retirement savings. It took them years to save this. Lose half of it up front to buy some real estate that may or may not work.
So now, just to extend that, you've got 600,000. Forget the fact that you lost 400, which is bad enough. But look at it from an investment standpoint. Now you have $600,000 that has to do the duty of $1 million.
That's right.
It's very difficult.
And I was shocked at this. He goes, so people that come to my 2-day seminar, 90% of them sell every retirement account they have immediately, pay the taxes because they're going to make so much more in this investment. So then I was like, that's shocking. I can't believe the horrible. Now remember, this is not a financial advisor. This is a real estate salesman. They're trying to sell you a program to buy real estate or some kind of deal, but it has nothing to do. They're not financial advisors. They're not legal fiduciaries. They don't care if you go completely broke. They've already been paid. They do not care. So the next caller called in. This person sounded a little more astute. I don't know about trading in retirement accounts, but I've got a house paid for. The speaker immediately says, get a mortgage on that house. Are you crazy? You're only paying 3 or 4%. We're paying you 10 or 15%, and you control the money. Oh my gosh, what a mistake by having a house without a mortgage. And then the caller says, well, I have a $1 million IRA. Well, you got to cash that one out too. I go, holy moly. That's not the worst of it, folks. The worst of it was the person was only 55 years old. And so, oh, you don't have access to the 401k. She goes, no. Can you quit your job? So, think about this. You've got a supposed expert on finance, or not, they're just a real estate salesman. An expert on finances telling you, quit your job, get your 401, cash it out, pay 40% tax on it, and get a mortgage on a house that you already have paid for. So what happens when you have all of this and real estate goes down, which it has every single time in history? It goes up from demand, low supply, high demand. Then people overbuild. They always do. How many friends of yours are now getting into rental properties and never would think about it in the past? Everybody is. Trust me. Yeah. I'm buying an apartment building. I'm doing this. Everybody. They overbuild. It goes straight down. So when that happens to this individual, now they've got to pay a mortgage payment. They cannot sell this property because real estate people tell you can sell into a losing market. Try it.
Oh, yeah.
If the market's going down, unless you're fire selling that thing, I mean really fire selling it. So you can't get out. You got people that are retired that are completely broke now. This salesman walks away, doesn't care what happens to you. That is the worst advice I've ever heard in my entire life.
Now, this stuff seems pretty easy to recognize, and it's easy to say, I would never do something that silly, which I understand. And one of the reasons we're talking about is it's so blatant. But there's a lot of them out there that are more subtle. They have good spiels. The potential is intoxicating and tempting for you to do. So
why would you let the government tell you what to do with your money? Control your own money.
You got to be careful.
Oh, but 90% of people apparently go to these seminars, cash out all their retirement accounts. That is ridiculous. They used to tell you put your retirement account in the IRA. Then actually people started fighting back going, hey, I'm getting profit problems here.
Yep.
I can't fix an air conditioner because I don't have any more IRA money.
Sell it.
Get rid of it. It is ridiculous. I thought the worst advice I ever heard was these option traders telling you you're going to make 4% every month. You can retire at any age.
Yeah.
Oh, you're 25 years old? You got 40 grand? Of course you can retire. We make 4% a month. One of the reasons I call this the Common Sense Investing Show. If you forget the hype, pull away pull yourself out of the situation or the salesman talking to you, you can really avoid a lot of these kind of traps. Remember, we warned against the life settlements. We warned against trading. Now I'm warning against putting all your money in real estate.
And unregistered REITs are in there too.
I own homes. I own real estate. I like real estate, but I'm not crazy enough to cash out retirement accounts, quit my job to get access to a retirement account just to get part of them.
But I will add, even if you did something silly like this and it got back by all your criteria and your due diligence, if your income was taken care of, it wouldn't be as devastating.
That's right. And sometimes you have to take it out of your own hands.
That's absolutely
not
true.
Having access to that's why 401k is not that bad of a thing. Not having total access to it because of the tax and penalty situation isn't always a bad thing. It sometimes will prevent you from doing stupid things with your money. Remember, if you have any financial questions or like to take advantage of any of our no-cost, no-obligation programs, it's 972-715-2424. Again, 972-715-2424. You can go to ilovemyretirement.com. We have a break coming up. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show, folks. Remember, we're talking about scams, how not to get scammed with your money. We're talking about real estate, people telling you put everything, sell your 401ks, quit your job, or the option trading people that you can retire at 25 years old with 20 grand, crap like that.
The problem is we've talked about this many times on the show, and for the listeners that really take heed, one of the two, the spouse, usually doesn't take an interest, at least actively, in the retirement and the finances. One is usually really good at it and keeps up on it, and the other one not so much. If the one that passes away first is the one that takes care of all of that, it really leaves the other person vulnerable. This seems obvious to most of us, but it's not, and there's a lot more subtle ones out there that can catch that person off guard.
What you find is these are professional salesmen, okay? You got to dig deeper, because what they're going to say is, oh, that McClure and Allard, they're just part of that Wall Street thing. They don't want you to take money out of your IRAs, obviously, because they want to make commission and fees on it. They'll say stuff like that. But the truth is, when you have 30 years experience, 5 different government agencies that monitor you, you're a legal fiduciary. In other words, you're qualified education-wise, experience-wise, and license-wise to give financial advice, or you have squadoosh.
And that's still not a guarantee you're going to get a good investment from that type of person or a fiduciary. But you've got to have a place to start. That's the foundation. Take no less than that. You start there, and then you improve.
Yeah, because somebody that's just a salesman of it, you could tell them, I'm 86 years old, and I have $1 million total in my name. I'm thinking about putting all of that in your real estate program. They'd say, absolutely, ma'am. When can we pick up the check?
That's right. And can you take a loan out on your house? That's right.
This person didn't ask them about their objectives, their risk tolerance, their time horizon, any of the things you need before you make a recommendation for an investment or a strategy. They said, nope, no matter what you have, every single answer and every solution to your problem happens to be my particular rental property program.
Yep.
It's ridiculous, but more people fall for that, and these people sound like nice people that were calling, and they believe it because they've been listening to this stupid show for all that time.
You think they were real calls?
They sounded real.
All right.
I think they don't care. Everybody should cash in 401ks, do everything you can. As long as you're getting in their real estate deal, you're going to be fantastic. And I know how hot real estate is right now. That's why that's the scam now. It was different things over the years. Now it's real estate.
Wait till gold starts heating up.
We got all them.
Yep.
All right. Remember, we developed this show to answer your financial questions. So many shows. It's an hour-long tribute to them and how to come to my next seminar. You can learn a bunch of stuff if you just come in.
I'd like to do an hour-long tribute to me. Can we do that next week?
I don't think it'd take an hour.
Oh, there it is.
But on this show, we answer your financial questions. We give you advice. We do hope you'll do business with us. But even if you don't, these answers will help you in your financial future.
And we help a lot of people and send them to discount brokerage firms and other places that's more appropriate for what they're trying to do. It's not all about anyone that comes here has to invest with us.
That's right. All right, what's our first question?
All right, first question. The thing that we all want to do. What is the first thing you'd advise a lottery winner to do? My answer to that would be learn the word no. Learn how to say no.
Change your number. Don't tell
That's
any
right.
of your relatives.
No,
First thing
that's
to do is do not tell relatives.
I told my wife, Chris, I said, if we ever win, you can't tell anybody. We'll just lose friends.
How come Guy has this $10 million house? They got
Yeah.
brand new rolls. Is there? No, none of your business.
Yeah, that's right.
Well, we're kidding, but not really kidding.
No.
You need to not tell anybody for sure. But it's the same kind of advice I'd give to anybody. Anybody. Here's the first thing you do. What do you do if you have a bunch of money handed to you? Well, you protect you from you, number one. In other words, okay, what gives me a guaranteed, let's say I want $100 million. Okay, I want $2 million a year, $5 million a year, whatever the number is, coming to me every single year until I die. That would be the number one thing. So if I got stupid and wanted to buy a couple of Rembrandts or something, I'm still not going to go broke. Next year I'm going to get another check. That is the first thing. But isn't that the same thing we do with retirement planning?
Absolutely.
No matter what happens, you get a check every month. You don't have to worry about the stock market going up, interest rates going up. No matter what, a check comes to your house every single month to pay your bills.
And if it's a large amount, we would work hand in hand with an estate planning attorney. We'd set up some things, depending if you want to be charitable or, some exit strategies for the family. There's lots of other things.
So the first thing is set up income. Now, I do advise taking the lump sum versus the pension, unless you really don't have that much strength.
Self-control.
There you go. Which is hard, especially if you've never had money before. It's kind of like a win. Woohoo!
Oh, I had a buddy that retired, actually moved to Washington. His name's Greg. And he used to always joke, if I ever win the lottery, first thing I'm going to do is hire 2 big bodyguards to protect me from myself.
Punch me in the mouth. I'm about to go crazy.
That's right.
But that's what you have to do. Then you do have all the estate issues and things like that, because when you have a large estate, but the typical retiree has a similar problem. They've accumulated this money. Now what to do with it? And just like I told them, think about it. Does it make sense if you want $100 million to take out some of it and guarantee a certain amount every year till you die, no matter how long you live? Of course it does.
And that's why retirees are targets. They've saved their whole life. They've got a lump sum of money. Everyone wants it.
Now, does it make sense to take that same lottery winner and buy more lottery tickets all the time? I'm going to put $10 million a year in lottery tickets.
That's right.
No, you've already won. You have the assets. Now you need to start protecting yourself for the rest of your life. Then you do the other things like investing and, buying vacation property, things like that. Because you have to protect yourself from you, the economy, and anything else. And we had a break coming up, folks. So stay with us. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Today we're answering your financial questions, but remember, if you'd like to take advantage of our no-cost, no-obligation retirement plan, now you can be 40, you can be 70, 80. Once you're 80, you don't need a retirement plan anymore, but you might want to talk to us about investment questions. But a retirement plan is a written-down plan that shows you what your life is going to be like. It shows you if you have expenses of, say, $5,000 a month, $10,000 a month now, what's it going to be like in 10 years, 20 years, 30 years? Even if you have modest inflation like 2%, what are those expenses going to look like? How does that eat into your plan or your income that you have coming in? Because once you get on a fixed income, you got this income, but those expenses keep going up. They keep going up unless you think your medical costs are going to go down, your electric bill's going down, water bill. They aren't. You need to see what it actually looks like. Even people do rudimentary, simple retirement plans in their head. More people do this than anything. They go, okay, I saved this $1 million or 300,000 or 10 million, whatever
the number.
I'm getting 3,000 from Social Security. I need another 3,000. They do the simple math in their head. That's 30 years. Oh man, that'll get me to 80 years old. No way I can go broke. They totally forgot inflation. Yeah. And the power that does, or the
and havoc. Over 30 years, it's a big number.
Oh, it's a huge number. Your 5,000-10,000 expenses have the exact same lifestyle. Could cost 10 or 15.
That's right.
And it really ramps up the losses. So you cannot do a simple calculation. You actually need somebody that will factor in inflation and all that. Plus, hey, give yourself a break. Give yourself cost of living adjustments for your Social Security. even though they might not be there, just to be on the low end of those to make sure.
And it's
Social Security will go up too.
It's still simple math, but just think about it. The more you need, the less money you have. The less money you have, the less money you can earn, and it's just a death spiral.
And as part of this no obligation complimentary package is a Social Security optimizer. Okay, you actually have you can have a written retirement plan when you leave Dillon Gage instead of just some sales pitch about an investment or some strategy. Remember I told you the big firms calling people, giving them advice. No, don't do this. You need to do this. They've talked to you for 2 seconds.
Yep.
We're going to collect a lot of information before we make any strategy recommendations, if any. Some people are doing pretty good on their own, and we'll tell you that.
And I'm going to go rogue here a little bit. Victor doesn't know that I'm going to bring this up, but here we go. I had a few people over the weekend ask me, gave me instances. If I had $200,000 and I didn't need income for 5 years, or if I had $450,000, I didn't need income for 8 years, how much could it get me? If that would be of more help to you than going through the whole financial analysis, which we're happy to do, call us. Let us know your age. If you want to just get a quote, get a ballpark, see what it could do for you, how many years you can defer it, a dollar amount, and to give us a little time, we can run some illustrations and we can give you actual quotes on how much your money or parts of your money can generate for you. It's a big help.
972-715-2424. Again, 972-715-2424, or you can go to ilovemyretirement.com. All right, Guy, what's my next question?
All right. That one was a fun one, but let's see what the next one is. What is the difference between tactical and strategic asset management?
Okay. There's two different kinds of managers. You got like a buy and hold manager, right? Then you've got a person that tries to take advantages of difference in the economy. Many times, the strategic buy and hold wins, especially when the market's going up, right? If you long term, if you have a really long time horizon, like 30 years or so, I think strategic wins out more often than not.
So if you didn't catch that, strategic is the buy and hold.
That's right. Remember when the market went down 50% in 08? Maybe you remember it when it went down 2000 to 2003.
Oh, yeah.
And you called your broker and said, oh, my gosh, the market's down. What are you going to do? Stay the course. Whatever you do, don't sell. You'll realize the loss.
Don't capture that loss. Exactly.
Trust me, it's already gone. You're just trying to get it back.
Yeah, that's right.
But those are the things. And if you are built for that, in other words, if you think I can withstand any losses, 50%, somebody told me the other day, it can't go down 50%. I go, it's done it twice in 15 years. It sure as hell can. They go, but if you're okay with that, there's nothing wrong with a strategic. Now, there's several kinds of strategic. There's managed strategic, and there's passive strategic. In other words, people manage a portfolio. They're going to overweight certain sectors, certain industries, underweight others, certain international stocks versus others. They might go a little bit more on emerging markets than normally you would. Those sometimes work, but I'll tell you what, if I'm going strategic, I think I'm going simple indexing. Like an index fund, that's going to get virtually no fees, and you're okay with the risk, right?
That's right.
So there's nothing wrong with that at all. Simple indexing or ETFs make the most. You can do individual stocks, but it's really hard to really diversify, fully diversify. You could give yourself 100 stocks. Your statement's going to be 40 pages long, but 100 stocks is not going to cover the 10 industries in America, plus all the sub-industries and alternative.
I've been saying just that since about early 90s. Now, Warren Buffett in the last 5 years has come. I think you heard me, and he's talking about the indexing too. So
yeah, no, I
he
like
probably
it.
listened to our show.
Nothing wrong with index. If I'm going to do strategic, and I can handle the risk, I'm going indexing. Now, tactical is a different matter, and we'll talk about that after we get back to the break. But remember, if you have any financial questions, don't hesitate to call us at 972-715-2424. We got a break coming up, folks. Stay with us. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is based on common sense instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Today we're answering your financial questions. Right before the break, we had what is the difference between tactical and strategic asset management? We explained that strategic is a buy and hold typically. Now you'll have managed strategic and passive strategic. And the passive would be index funds. stuff like that. In other words, you're willing to take the risk of the market. You want the lowest fees. Nothing wrong with indexing. You can do individual stocks, but you can't get the diversification that most of us need. Then you've got, managed strategic, all right? And those are underweighting, overweighting certain sectors of the market. They might eliminate certain sectors based on their research. Now, all of these guys are going to sound, or gals, are going to sound really good. Do you realize our research department has a combined 10,000 years of experience? We have PhDs galore coming out our ears.
We've seen some great managed programs that were mechanical, so there's no motion, had short, medium, and long-term positions in each position, meaning 3 positions per position, so that the market was going up and down, it would follow it. Did great for how long? 7 years? 8 years?
A lot.
It made 100% a couple of years. It was great until the market showed it something it hadn't seen.
But then you have tactical estimates. Tactical means they're trying to take advantage of different things in the market. In other words, we think right now utilities are undervalued relative to their historic PE ratio, whatever. And those are good if you believe you can, there are inefficiencies in the market and you can take advantage of those.
Or healthcare is
right.
hot, or real estate, as we talked about.
Right. And they're also good, though, if you have a 7-year bull run like we do now. 7, 8 years.
Makes everybody look good,
That's
doesn't
right. I think it's been 8 years. It really is it's topped out here about the last year and a half or so. But do you know how many times, Guy, the market's gone up 9 years in a row? None.
That's scary, right?
Then you go to 10. I have no idea. No. Goes up to 10. Never. So you're walking into virgin territory now. And anybody tells you the market's not overvalued is using a metric that I've never heard of. Even though I've been listening to these convention things lately, and the exact same news information, it has a completely different spin.
I don't know, though. Everyone's seeking yield. We talked about it last week. Internationally, they're looking for a safe haven, which we kind of are. I mean, there's a lot of reasons why, even though there's not much growth anywhere, that the market's still going up some, right?
Like our managed program at Fidelity is an interesting one, where basically it's in every sector of the S&P, which are 10 sectors.
Right.
And it's got alternative, fixed income, stuff like that. If any of those sectors go below its moving average, it's automatically out of that sector. So do I think that is a better program when a market is topping out or overvalued? Absolutely, because you're going to need some downside protection right now. It's much more detailed, comprehensive program than some of the other ones out there that just use the S&P 500. This is much more detailed. In order for you to get out of that one, the market's got to go down some to get below the moving average. With mine, I might have shed 8 or 10 of those sectors already. Same thing when it's coming back. Sometimes after the market drops, the comeback is the biggest part of your return. So if you're just based on a moving average 1, then you're not going to get it until you're going to miss out on that rebound.
That's right.
Trying to explain. With ours, it still takes advantage of those rebounds because it's going into every sector, and each one's based on its own moving average. The more volatile sectors will have a broader moving average. The least volatile will have a narrow moving average. So that way you're getting a true representation of where the market might be headed. It's more of a momentum play. And when the market is topping out, I think that's your best case. I mean, that's your best choice. If you have any information, like a free information kit on our managed program, it's 972-715-2424. Now, remember, does that mean buy and hold is not good? No. This is for people that want market returns but want protection. They want some kind of hedge in. They want a protection. So that's why I think when the market's topping, it's great to have protection. Now, if the market drops 50% again for the 3rd time in 15 years, if that happens, hey, that buy and hold is a pretty good option again. The strategic buy and hold is a pretty good option again. All right. What's our next question?
All right. Next question is, if I'm still working, do I have to sign up for Medicare?
You should. Yeah, you got to sign up for Medicare. Medicare, when you're 65.
To enroll.
Now, even if you're going to keep working, your primary, if you work for a company that has over like 20 people, your primary could be your current plan. If it's under, it's going to be Medicare is going to be your primary insurance. You'd have 2 in that case. But just make sure there's 3 parts or 4 parts of Medicare. Your Part A was the original Medicare. That's your hospital. Used to be they just went for hospital costs, right? Going to the doctor had nothing to do with insurance way back in the day. Then Part B is the medical coverage. That's your going to the doctor and all that kind of stuff. Because remember, in the old days, you couldn't get an X-ray at a doctor's office. You couldn't get really any procedures. They checked you out and took you to the hospital.
Yeah, they all have their own machines now.
That's right. Part C that's a Medicare Advantage plan, and that's the one I'd recommend the most. That's parts A and B together, and a lot of them have D together. D is the prescription drugs. My father went through cancer twice. He had a good supplement policy. That's what a Medicare Advantage is, a supplement policy. He never paid a penny. And some of the co-pays on Medicare alone, standalone Medicare, get pretty high. I mean, you can pay $10,000 a year. I can't remember the exact number, but it's 20% up to a certain number. So you can pay $5,000 or $10,000 and still have all those prescription costs and everything else. So I think it's better having that supplement. He only paid, $100 a month. It might be $200 now. Still well worth it, because the medical cost can be a huge part of your overall expenses as you get older. Just remember your Part D, the prescription stuff, you've got from October to December 7th of October 15th to December 7th of each year. You can change things if some life-changing events. You can switch in between plan years. I am no Medicare expert. I want you to know that. We are not Medicare experts. But there's certain things we can give you a broad.
And we can get you to one, certainly.
If you're already taking Social Security, by the way, before you're 65, they'll automatically enroll you in A and B. Okay? And the premiums are based on if you make under or over $85,000 a year. Your premiums can double if you make more. So that's we got a break coming up, folks. Remember, if you have any financial questions, don't hesitate to call us at 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by the kings of common sense, Victor McClure and Guy Allard.
Welcome back to the show. Remember, if you'd like to take advantage of our no-cost, no-obligation written retirement plan, Social Security Optimizer, don't hesitate to call our hotline at 972-715-2424. This is really good if you're within 10 years of retirement or already retired. It's amazing how many people don't have it. It's not even 10% of individuals out there have a retirement plan. They just hope what they've been doing the last 20 years is going to continue for the next 20. And if it doesn't, I don't know what to do. You can make a plan right now to protect yourself, but at least you'll know. Here are the potential pitfalls in the future. Not knowing is worse to me. I've got to know so I can take positive steps to prevent that. So I know it's coming.
How many people do you know, and some are doctors and stuff that we've talked to, but because they were making huge income, 300, 400, north of that even, a year, they didn't feel the need to save, much less have a plan, but they didn't need to save. Why? Because they're going to make the money next year, and and it doesn't always work that way. You have to plan.
I have calls every single week for somebody calling me, well, we saved about $900,000. I said, well, it doesn't matter what you saved, it matters how much you're spending. Well, I only spend about $15,000, $12,000 a month. I go, let's do the math on that.
Yeah, that's tough.
So but that's why you need to have something written down. It really helps. Our number 972-715-2424, or go to ilovemyretirement.com. All right, what's the next question?
All right, very timely question came in this weekend. Is it a good idea to wait until after the election before making any financial decisions regarding my retirement?
No.
Yeah.
Because the problem is the election doesn't have anything to do with it. With the choices we have today, it's probably both going to crash the market, so it doesn't matter.
Well, and the point is you're going to lose all the time and the opportunity and all of that between now and the end of the year anyway, and you don't want to lose the time.
What you ought to do is you got to figure out, if you get a plan, you can try to determine when to implement that plan. But it usually, whatever you choose, when I was in the military, we had something called the 50-50-90 rule. If you have a 50-50 shot, should I sell, should I buy? 90% of the time, you're going to be wrong.
Well, and think about it. If you really, again, the Common Sense Investing Show, think about it from a common sense point of view. Will the election change the amount of money that you have saved right now? No. Will the election change what your projected budget in retirement will be, whether it's $5,000 you're going to need or $10,000 a month you're going to need? Will that change it? No. Think about what it really is going to have. It may probably will have an immediate effect on what the market does. So if you're a day trader, whether you should get in and out of the market and what sectors, as we talked about before, you might want to be in because one president is in opposed to another, then that would be key. But if you're just planning for retirement, the money you've saved, you've got, the money you're going to need, we can help you figure out what that's all about, and you can still get that income.
I'm going to give you one caveat to that. The one thing you don't do. A lot of people are afraid to do anything because they're afraid to make a mistake.
Right, oh, yeah.
When inaction is the mistake.
They get paralyzed.
Right. Analysis paralysis, they call it. But think about this. You know the market's overvalued. Have you ever read a PE ratio in your life? You know the market's overvalued. It never goes up forever. Nothing ever does. So you know there's potential for a down market. With this kind of volatility, if you have a situation where if you did a retirement plan, it shows, hey, with this amount, you're fine. But what if it does drop 50%? That's what could happen.
Right.
By not taking action, you could watch the money go down. And I'm telling you right now, one modest down year will delay your retirement 5 years. A significant down year can delay it 10, 20 years. It gets crazy at a certain point. But remember, if you have any questions, our number's 972-715-2424. I think we got time for one more question. Maybe
All right, I'll throw an easy one to you. I'm considering a bond ladder. Is that a good idea right now? They must be talking about interest rates and such.
Yeah. The old school, and I do mean that's what I was taught, that's what you were taught, is you take your fixed income piece, which are CDs, bonds, and all that kind of stuff. If you're pro stock market, it's all going to be bonds. And you buy shorter maturities and medium maturities and long maturities. You might have some 30-year bonds, some 10-year, some 5-year, and 1-year bonds.
And in other ways, each year you could buy
That's right.
a
If
different
interest rates
maturity.
go up, you might lose on your old bonds,
Yep.
but you can buy the new bonds at higher prices. The only problem is the yield spread is almost flat. In other words, you got to go out 30 years to get 2.5.
Yeah, I know.
So you might get a 5-year bond for one. There's not enough of that spread. It used to be different where, okay, my short stuff's going to get 5, my medium stuff's going to get 7 or 8.
Yep.
I'm getting 10 or 12 on my long stuff. Right now, the bond ladders, buying different maturity bonds that go out, honestly don't make a lot of sense to me right now. It just doesn't make sense because of the yield curve is so flat. You know, normally you really make a lot more interest. But think about it. I think it's 1.5. It's been bounced between 1.5 and 2% on a 10-year Treasury. Man, it's 2.5 or something on a 30-year Treasury. That's not good enough.
Here's another question along the same line.
Sure.
What has more risk, bonds or bond funds?
Bond funds have more risk. Now, well, let me rephrase that. There's different kinds of risk.
Right.
Bond funds have more interest rate risk. Your bonds are going to have diversification risk because you're not going to be diversified enough because you can't buy as many bonds. I guess you could, but they could have 10,000 bonds in that thing, and you're not going to pick 10,000 individual bonds.
That's right.
So you got diversification risk on the bond fund, but real interest rate risk on the bonds. So I'll give you an example. Let's say you got a 5% bond. New rates are 7%. Nobody wants your 5% bond anymore, so you have to sell it at a discount to make it where the actual yield comes out 7 again. But you can hold that individual bond to maturity and get the full amount back. All right, so that's less risk than a bond fund where there are no maturities. They can't buy bond funds. I can explain that more in the next show. Well, thank you for listening to the Common Sense Investing Show today. If you have any financial questions or like to take advantage of our no-obligation retirement plan stress test or just have a financial question, 972-715-2424. Again, 972-715-2424. I'm Victor McClure for Guy Allert. We always appreciate your time.
The preceding show was paid for by the Dillon Gage Wealth Management Companies and Victor McClure and is for informational purposes only and not a solicitation or representation of any particular investment product or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives to make any financial decisions. There is never any guarantee of future success or performance.
The preceding was a paid commercial program paid for by the Dillon Gage Wealth Management Companies and does not reflect the opinions or advice